The news networks and financial pundits are practically throwing a parade, celebrating the fact that inflation has supposedly cooled down to a manageable 2.8%, while the Federal Reserve comfortably holds interest rates steady. They paint a glorious picture of economic victory and stability, assuring the public that the worst of the financial storm has finally passed. But when you stand at the grocery checkout line, stare at your skyrocketing housing costs, or review your monthly utility bills, a chilling and undeniable realization sets in. Why does your wallet feel emptier than ever, even when every major financial headline keeps screaming that inflation is finally cooling down and returning to normal levels? The brutal truth lies in a deeply ingrained psychological blind spot and a deliberate media narrative that intentionally confuses disinflation with deflation to keep consumer panic at bay. When the Federal Reserve announces that inflation has dropped to that 2.8% mark, they are simply stating that the speed at which prices are skyrocketing has slowed down slightly compared to previous years. It absolutely does not mean that the cost of your daily existence is reverting to those comfortable, affordable price tags you desperately miss from half a decade ago. Prices are still aggressively climbing higher and higher, ruthlessly building upon an already devastatingly inflated foundation that has been quietly draining your purchasing power and eroding your hard-earned wealth. This subtle linguistic trick keeps the working class sedated and spending, while central banks maintain punishingly high interest rates to artificially suppress broader economic demand. By holding these rates steady at elevated levels, the financial system ensures that your compounding credit card debt becomes excruciatingly expensive to service, while your actual wages remain mathematically stagnant against the rising tide of essential living costs. You are not failing at managing your money simply due to a sudden lack of willpower or discipline. You are actively participating in a rigged financial simulation where the institutional house always wins. What is the invisible psychological force truly controlling your financial destiny and pushing you closer to the edge, while the Federal Reserve resolutely refuses to turn the cheap credit valves back on? The phenomenon silently devastating your bank account right now is known among top economists as sticky inflation, a relentless economic force that refuses to retreat even when the broader market signals a temporary slowdown. While volatile categories like energy or used cars might show occasional price dips, the foundational pillars of your daily existence, specifically core services, insurance premiums, and housing costs, remain stubbornly elevated and permanently welded to a higher plateau. The Federal Reserve perfectly understands that once a landlord successfully raises rent or a corporate healthcare provider hikes their monthly premiums, those new prices almost never reverse course, regardless of what the headline inflation numbers suggest. You are constantly bleeding capital because the essential services required simply to survive and function in modern society are systematically designed to extract maximum value from your stagnant paycheck month after month. The cognitive dissonance you experience every single time you walk into a grocery store is scientifically documented as anchoring bias, a powerful psychological glitch where your brain stubbornly clings to the obsolete price tags of a pre-pandemic world. Your mind is permanently anchored to the memory of $3 milk and affordable weekend dinners from the year 2019, making every current transaction feel like a profound personal failure or an aggressive financial assault. This relentless mental friction forces your brain to process routine purchases as a traumatic event, constantly comparing today's astronomical reality against a nostalgic baseline that simply does not exist anymore in the current macroeconomic paradigm. Retailers and financial institutions expertly exploit this psychological vulnerability by introducing shrinkflation and disguised fees, slowly draining your resources while your mind desperately tries to reconcile the mathematical impossibility of maintaining your old lifestyle on your current salary. This chronic state of financial stress eventually triggers a devastating psychological breakdown known as frugality, fatigue, the exact moment when your sheer willpower completely collapses under the crushing weight of endless budgeting and deprivation. You spend months meticulously tracking every single penny, denying yourself basic pleasures, and fighting a losing battle against the rising tide of sticky inflation until your exhausted brain demands an immediate dopamine release just to cope with the misery. In a desperate act of emotional rebellion, you pull out your credit card to fund a vacation or a seemingly harmless luxury purchase, instantly falling right into the very trap the Federal Reserve engineered with their aggressively high interest rates. The moment you transition from paying cash to swiping borrowed money at 24% interest just to feel a fleeting sense of normalcy, the entire financial system locks its jaws around your future. The central banks and massive credit corporations are literally banking on your eventual psychological exhaustion, knowing full well that prolonged economic pressure will inevitably force the working class to bridge the affordability gap with catastrophically expensive debt. You are no longer just fighting against the rising cost of living. You are fighting a sophisticated algorithmic war against institutional giants who perfectly understand human behavior and have weaponized the cost of capital against your fatigue. As your willpower crumbles and the minimum payments begin to silently devour your monthly cash flow, a much larger mathematical reality starts working against you in the background with terrifying efficiency. What is the core mathematical mechanism that will completely change your financial game in an era where cheap money has vanished forever and compound interest has become a lethal weapon? The mathematical reality of our current economic landscape is entirely defined by an unforgiving showdown between the destructive force of compound debt and the wealth-building power of compound interest. When the Federal Reserve holds its benchmark rates at their current restrictive levels, the massive credit card companies immediately weaponize those policies by pushing the average annual percentage rate to staggering new historical records. Right now, millions of American consumers are carrying revolving balances at 21 to 24% interest, effectively trapping themselves in a mathematical death spiral that guarantees they will remain impoverished for decades. This relentless compounding effect means that every single dollar you borrow today multiplies rapidly in the shadows, quietly draining your future income long before you ever receive your next paycheck. The banking industry has brilliantly designed the minimum payment option as a psychological trap that provides you with a false sense of financial progress while actually maximizing their long-term corporate profits. When you choose to only send the minimum required amount to your credit card issuer each month, you are barely covering the exorbitant interest charges generated by that 24% penalty rate. You are essentially renting your own debt indefinitely, paying hundreds or even thousands of dollars over the years without ever making a meaningful dent in the actual principal balance you originally borrowed. This predatory mathematical mechanism ensures that a seemingly innocent weekend getaway or a necessary emergency car repair will end up costing you 3 to 4 times its original price tag by the time you finally escape the vicious cycle. However, the exact same high interest rate environment that mercilessly punishes borrowers also creates a profoundly lucrative opportunity for those who understand how to reposition their capital and become lenders themselves. Because the Federal Reserve is trying to pull liquidity out of the overheated economy, institutions are suddenly willing to pay a premium for your cash, offering risk-free returns of 4.5% to 5%. By aggressively moving your emergency funds and idle cash into high-yield savings accounts or short-term United States Treasury bills, you completely reverse the mathematical polarity of your financial situation. You transform your money from a depreciating asset into a tireless digital employee that works 24 hours a day, generating guaranteed passive income without exposing your hard-earned capital to the wild volatility of the broader stock market. Understanding this critical divergence between paying 24% on consumer debt and earning a guaranteed 5% on your liquid cash is the ultimate dividing line between the working class and the wealthy. It is not about possessing extraordinary mathematical genius or predicting the next massive stock market rally. It is simply about recognizing which side of the compound interest equation you currently stand on. Once you truly internalize the devastating cost of servicing high interest debt and the undeniable power of risk-free yields, you can begin to restructure your entire approach to capital allocation. What is the true difference in the mindset regarding wealth between those who are utterly crushed by sticky inflation and those who strategically use it as their ultimate financial leverage? The difference between the wealthy and the working class is not just a matter of simple mathematics. It is a fundamental divergence in how they perceive capital, risk, and opportunity cost in a distinctly hostile economic environment. When the Federal Reserve stubbornly holds benchmark rates high to crush sticky inflation, the average consumer completely panics and retreats into a defensive, scarcity-driven mindset, feeling like a helpless victim of massive macroeconomic forces entirely beyond their personal control. They bitterly complain about the profound unfairness of soaring grocery bills and skyrocketing utility costs, while paradoxically continuing to hemorrhage their dwindling wealth through terrible consumer debt decisions and impulsive lifestyle maintenance. The truly wealthy, however, embrace a completely different psychological framework centered around strategic capital allocation, recognizing that this exact high-rate environment is a rare historical opportunity to acquire discounted assets and lock in phenomenal risk-free yields. Instead of fighting a futile, emotionally exhausting battle against the rising cost of living by trying to maintain an unsustainable pre-pandemic lifestyle, they ruthlessly audit their spending and deploy every available dollar into wealth-generating vehicles. They fundamentally understand that every single dollar aggressively saved and invested today is not a depressing deprivation of current happiness, but rather a direct, calculated purchase of future autonomy and absolute financial invincibility. This profound shift requires a radical redefinition of what poverty and wealth actually look like in everyday life, completely stripping away the toxic social conditioning that falsely equates personal status with visible material consumption. Driving an older, fully paid-off vehicle, skipping the obligatory annual international vacation, or consistently choosing to cook nutritious meals at home instead of dining out might look like embarrassing financial struggle to an outside observer deeply trapped in the matrix of consumerism. In reality, these deliberate, disciplined sacrifices are the aggressive, calculated moves of a financial predator patiently accumulating capital while the rest of the mindless herd carelessly walks directly into the slaughterhouse of compound debt. You must completely reprogram your brain to thoroughly understand the mathematical concept of opportunity cost in a new era where money is absolutely no longer cheap, abundant, and easily accessible to the middle class. Every single time you swipe a high-interest credit card for a rapidly depreciating liability, you are not just paying the inflated sticker price plus a devastating 24% interest penalty, you are simultaneously destroying the exact capital that could have been earning a guaranteed yield. You are actively choosing a fleeting, meaningless moment of chemical dopamine over the permanent, unshakable security of financial independence, eagerly sacrificing your future freedom just to impress acquaintances who do not genuinely care about your economic survival. Transitioning away from this destructive scarcity mindset means you must permanently stop viewing budgeting as a restrictive, miserable prison sentence and start seeing it as a highly tactical blueprint for your eventual escape from the rat race. When you willingly and ruthlessly cut out meaningless, inflated expenses right now, you are literally buying back your own precious time, securing the vital options and the financial leverage you will desperately need in the next 3 to 5 critical years. You are meticulously building an impenetrable fortress of liquidity that will allow you to aggressively capitalize on the inevitable market panics, corporate layoffs, and desperate asset liquidations that always follow prolonged periods of punishingly high interest rates. To truly leverage this profound psychological shift and build lasting generational wealth, You must learn to completely detach your emotional well-being from the immediate gratification of modern consumer culture and the relentless corporate marketing machine designed specifically to keep you permanently broke. Society has meticulously conditioned you from childhood to believe that ultimate success is exclusively defined by the visible accumulation of luxury goods, brand new luxury vehicles, and massive 30-year mortgages that effectively chain you to a miserable corporate desk for the rest of your natural life. Breaking free from this pervasive psychological illusion requires an extraordinary level of mental fortitude and a deep, unwavering willingness to look completely foolish to your broke peers while you quietly construct a financial empire in the shadows. Ultimately, this psychological transformation is entirely about reclaiming your personal agency and recognizing that true, enduring wealth is not measured by the expensive things you own, but by the absolute, unyielding freedom you have over your own time, location, and daily decisions. When you finally stop fighting the overwhelming macroeconomic currents and start swimming strategically alongside the massive flow of smart institutional capital, the crushing anxiety of sticky inflation begins to rapidly dissipate. It is immediately replaced by a cold, calculating confidence in your long-term financial trajectory, knowing that you have successfully turned the system's most dangerous weapon into your greatest advantage. What are the exact actionable steps you must take immediately after turning off this video to protect your financial fortress and execute this massive shift in strategy? The moment this video ends, your absolute first priority must be launching a ruthless and systematic search and destroy mission against any outstanding variable rate debt in your portfolio, specifically targeting your aggressively compounding credit card balances. The Federal Reserve's current monetary stance guarantees that these predatory interest rates, often hovering violently around 24%, will continue to financially bleed you out if you only submit the minimum required monthly payments. You need to immediately halt all discretionary spending, liquidate any unnecessary household items, gathering dust, and violently redirect every single available dollar toward completely obliterating these high-interest liabilities before they totally consume your future wealth. Once you have successfully extinguished the raging fire of consumer debt, your immediate next operational step is to aggressively lock in the exceptionally high risk-free yields currently available across the broader financial system. With institutional liquidity tightening, banks and the United States government are practically begging for your capital, offering guaranteed returns on certificates of deposit and short-term treasury bills that consistently surpass 4.5%. By strategically moving your dormant emergency savings out of traditional checking accounts and into these secure, high-yield financial instruments, you are essentially building a mathematically guaranteed fortress that actively defends your purchasing power against the relentless erosion of sticky inflation. The third and arguably most critical step in this comprehensive financial survival strategy is to completely automate your defensive wealth building mechanisms by consistently funneling capital into broad market index funds, specifically targeting the Standard & Poor 500. Human psychology is notoriously fragile, and if you rely solely on your own emotional discipline to manually invest your money every single month, you will inevitably fall victim to market panic, media manipulation, or the sudden, overwhelming temptation of a short-term lifestyle upgrade. By setting up an automated, recurring transfer that purchases shares of top-performing American companies regardless of daily economic volatility, you effectively remove your own deeply flawed human emotions from the wealth accumulation equation. Executing these three foundational steps requires zero specialized financial genius or insider Wall Street knowledge, but it does demand an absolutely brutal level of personal discipline and a profound willingness to delay your own immediate gratification. When you systematically destroy your toxic debt, secure guaranteed yields on your liquid cash, and automate your long-term equity investments, you transition from being a passive victim of macroeconomic policies into a highly calculated architect of your own financial destiny. However, even the most disciplined investors remain incredibly vulnerable to deeply ingrained behavioral pitfalls. What is the ultimate psychological trap that could violently throw you right back to square one, and how exactly do you avoid it when the dark night of stubborn inflation has yet to break?